You've been talking a lot about inflation. You've been talking about inflation really, I mean, since we started listening to you years ago, but a lot in the last 2 years. And so the normal rate of inflation is the next question, but I know the normal rate all depends on what the government is doing to, what consumer prices and whatnot it's tracking to really come up with the normal inflation rate. But what is historically the normal rate of inflation, and what are you seeing that's happening now?
Well, there is no normal rate. I mean, ideally, if you're talking about prices, consumer prices, because most people, when they talk about inflation, talk about, consumer prices. The normal thing in a free market economy for consumer prices is to go down. That's what's normal. And in fact, if you look at the US economy in the 18th century, right, from 1800, or rather the 19th century, the 1800s, from 1801 to 1900, prices fell for 100 years. I mean, the general price level in 1900 was half of what it was in 1800. So prices were cut in half over 100 years. And during that 100-year period of falling prices, Americans prospered. I mean, if you look at the second half of the 19th century, the Industrial Revolution, that economic growth that we enjoyed as Americans during that period far exceeds anything that's taken place since, either in the 20th or now the 21st century. So we had massive economic growth, yet prices were going down pretty much every year. So we don't get that anymore. We get rising prices. I don't know what the normal rate, the historic average rate is certainly lower in the last decade than it has been. But a lot of that is based on the way the government measures prices. Because over time, the CPI, right, or some of the other official government yardsticks have been dramatically altered so that no matter how much prices go up, the CPI doesn't really reflect that. And I think that is by design. I mean, the government creates inflation deliberately for its own purposes, its own benefit, but then it wants to cover up the effects of inflation so the public doesn't complain and the Fed can continue to justify its monetary policy. But, if we still measured prices using the exact CPI that we used to measure them in the 70s, I think the annual gains would already be well into the double digits. In fact, for 2021, the first digit may be a 2, not even a 1. That's how bad it already is. And it's going to be even worse in 2022.
So paint us a picture about that, Peter. What do you believe is the real, if you can? Because I've heard you talk, and you just mentioned that how they report it isn't exactly covering everything. It's mixed statistics. What do you think the real rate of inflation is now? And paint us a picture for a year out. Where are we headed?
Well, it's high. I think it's double digits. It's north of 10% and headed higher. And there's no relief in sight. If anything, it's going to get worse, because from the government's perspective, allowing inflation to get worse is better than fighting it. Because if they fight it, they're going to immediately set off a chain of events that is politically a non-starter, right? If the federal government or the Fed were to fight inflation, we would have not only another real estate crash, stock market crash, bond market crash, we'd be in a depression, and the US government would have to slash spending. I mean, we wouldn't be talking about how much new stimulus we're going to get. It would be how much of the old stimulus are we going to lose, right? The government would have to contract. See, there's a big difference. If you look at where we were in the housing bubble that kind of popped, in 07, right? The Federal Reserve under Greenspan lowered interest rates to 1%. That was a mistake. And then it took the Fed a long time to get back up to around 5%. That was also a mistake. And during that period of time, we inflated this housing bubble. But at least the Fed tried to normalize interest rates. And it was the increase in interest rates that pricked that housing bubble, because it increased the cost of financing a home. And then by increasing the finance costs, it made homes more expensive, more people people could no longer afford to pay those prices. Prices started to fall. When prices started to fall, people started mailing in their keys because they couldn't make their payments. A lot of people had adjustable rate mortgages that reset with the higher rates, and it was a collapse. But this time, the Fed lowered interest rates to 0, which was an even bigger mistake than 1, and has left them there pretty much for the last 12 years. I mean, there was maybe 1 year, 1.5 years where, we got above 0, we got up to about 2%, and then we went right back down to 0. But the Fed never normalized interest rates, nor do I think they have any intention of even lifting interest rates above 0. So rather than pricking the real estate bubble, what they're going to do is end up pricking the dollar bubble, which is an even bigger bubble. We're going to have massive inflation. And then instead of real estate prices crashing, they end up going up even more because the dollar crashes instead. And as the dollar loses value, you need more and more dollars to buy anything, right? That would include real estate. But where I think you're going to see the decline in real estate values, as well as stock values and all sorts of other assets, is if you measure them in the price of gold. Because I think
we're going to get to that towards the end.
Yeah.
And I also want to talk to you about hyperinflation too, because that's something we're seeing more and more people talk about. The next question we wrote down. So in real estate, they say the average rate of appreciation for a house every year has historically been about 3%. Appreciation, inflation, call it what you will. So can you explain to them what the difference is between appreciation and inflation in economic terms?
Well, in appreciation, you would think of the real value of an asset over time. If it's appreciating, it is gaining a value. But if its price is only rising as a reflection of inflation, really a loss of value of the money that you're using to measure prices, then it's not a real appreciation. It's like if I measure myself with a ruler, 12-inch ruler, and I'm 6 feet tall, and then I knock an inch off the ruler, so now the ruler only has 11 inches, and now I'm, 6.5 feet tall. I didn't grow just because I'm measuring my height with a smaller ruler. So if the dollar loses value, and now you price your assets in dollars that have diminished value, that doesn't mean that the asset is actually appreciated. It just means the currency that you're measuring it in has depreciated. And I think that's really what's going on with residential real estate. It's reacting to inflation because there's no reason for real estate to appreciate unless you improve it, right? You actually physically have to do something to the house, make it better. Because if you just live in a house, it's going to depreciate over time because you're using it. It wears out like anything else. And unless you spend a lot of money maintaining the house, it's going to lose value even faster. I mean, think about all the houses, in our neighborhood that are teardowns. I mean, what is a teardown? A house that used to have a lot of value and now it's worthless because it's out of date, and people want to get rid of it and build something new. What could make real estate appreciate is if the location, for example, becomes a lot more desirable, again, like what we're experiencing here, where you have a lot more demand for real estate in one area, but that would come at the expense of a loss of demand for real estate someplace else. Because if a lot of people want to move into a particular location because now that location is more desirable, well, they're moving from someplace else. So that other location is becoming less desirable. So in aggregate, you're not seeing any real increase in value. You're just seeing some markets going up as other markets are going down. But to see the entire real estate market going up by 2% or 3% a year, that's really a reflection of money losing value and therefore real estate being more expensive to buy, even though it's depreciating because you're using it, right? But then if you improve it, if you buy a house and you add a bedroom or you redo the kitchen and you make it nicer, that can make it more valuable because you added value, you spent money. But once you've made those improvements, as you use them, the house gradually deteriorates again because you're using it. Just like you buy a car, nobody buys a car and expects it to be more valuable after they've driven it for a few years. It loses value. Houses also lose value. They just lose value more slowly than cars.